Welcome to lecture 1.2. In this lecture, we will understand what we mean by the current account of a country. So let us get started. So to give you a preview, in this lecture, we will discuss in detail what we mean by the current account. We understand what is the role of current account in national income accounting. Finally, we elaborate on what we mean by the term national saving. We then understand what is national saving for a closed and open economy. And finally, we discuss the two components of national saving, which is the aggregate savings of the public sector and the aggregate savings of the private sector of the economy. What are the key learning objectives of this lecture? Well, after this lecture, you should understand how the current account balance of a country represents a change in a country's net foreign wealth. The second key point to understand is how national saving is different for a closed and open economy. Just like in the previous lecture where we understood that gross national income is different for a closed and open economy, this implies that national saving is also different for closed and open economies, and it is important to know the difference. Finally, when we break the national saving of an economy into public sector savings and private sector savings, it is important to understand the various forms a country's private sector savings can take. So with this, let us start this lecture and understand first what we mean by the current account. The current account records a nation's transactions with the rest of the world, specifically its net trade in goods and services. In other words, current account, which is abbreviated as CA, is equal to the difference between the exports of goods and services, EX, and the imports of goods and services, IM. What do we mean when we say that a country has a current account surplus? Well, a current account surplus means that the net trade in goods and services of the country is positive. Or in other words, the value of the total exports of that country is greater than the value of the total imports. On the other hand, when we say that a country has a current account deficit, this means that the net trade in goods and services of that country is negative. Or in other words, the value of the total exports of that country is less than the value of the total imports. So now that we understand what a current account is and what we mean by current account surplus and current account deficit, let us understand the role of current account in national income accounting. If you recall, in the previous lecture, we discussed that the aggregate income or aggregate output for an open economy is equal to the total expenditure on aggregate consumption C plus aggregate investment I plus government purchases G, and to that we also add net exports, which is equal to exports EX minus imports IM. But we know that the difference between the exports of goods and services EX and the imports of goods and services IM is the current account balance of a country. Hence, we can say that the current account balance of a country is also equal to the aggregate national income of the country Y minus the sum of aggregate consumption, aggregate investment, and government purchases. C plus I plus G is also known as domestic absorption. In other words, current account of a country is equal to aggregate income Y minus the domestic absorption. Now let us discuss current account deficit in a bit more detail. When a country has a current account deficit, this implies that the country buys more from foreigners than it sells to them. From the previous slide, we can see that a current account deficit also implies that Y is less than C plus I plus G. What this implies is that when a country has a current account deficit, its total national income is less than its domestic absorption. As we discussed in the previous slide, domestic absorption of a country is the sum of aggregate consumption, aggregate investment, and government purchases. Now you may wonder, how can a country spend more than its national income? Well, just like in the case of an individual, if total spending is greater than total income, the country needs to borrow from foreigners to finance the additional imports. On the other hand, it is straightforward to see that a current account surplus implies that the country's total national income is greater than its domestic absorption. You may wonder, what does a country do with the extra income that is not used as consumption, investment, or government purchases? Well, a current account surplus implies that with the extra income, the country finances the current account deficit of its trading partners by lending to them. Current account surplus therefore increases the net foreign wealth of a country. Why? Because when you lend to other countries, you own foreign assets. And as you build foreign assets, your net foreign wealth increases. On the other hand, when a country incurs a current account deficit, its liabilities to foreigners increase, and there is a decrease in the country's net foreign wealth. Hence, we say that a country's current account represents the change in its net foreign wealth. We define net foreign wealth as a country's claim on foreigners or foreign assets, minus a country's foreign liabilities. It is important to note that current account is a flow measure, while a country's net foreign wealth is a stock measure. Another example of flow and stock measures is income and wealth. Your income is a flow measure as it is the amount of money you earn per unit of time, while your wealth is the total amount of money you have at any point in time. And it is important to understand that persistent current account deficit over a few consecutive years can quickly add up and lead to a substantial decrease in the net foreign wealth. This graph shows exactly that. The blue line in this figure shows the US current account from 1976 to 2015, while the red line shows the net foreign wealth of the US in the same time period. As you can see, in the early 90s, US had a small but positive net foreign wealth. However, starting from late 90s, the US has incurred consistent current account deficits. As a consequence, as you can see, the net foreign wealth of the US has declined very substantially from nearly zero net foreign wealth in the early 1990s to a $7 trillion of foreign debt by 2015. Now that we have a good understanding of the current account, let us understand what we mean by national saving and how national saving is related to the current account. We define national saving as the portion of aggregate income or aggregate output Y that is not devoted to consumption C or government purchases G. Hence, national saving is equal to Y minus C minus G. Given this definition of national saving, we can say that for a closed economy, national saving and aggregate investment are one and the same thing. And why is that? Well, that is because we know from the previous lecture that aggregate income Y for a closed economy is simply aggregate consumption plus aggregate investment plus government purchases. We can therefore rewrite aggregate investment to be Y minus C minus G, and we have just defined Y minus C minus G to be equal to national saving. Hence, for a closed economy, national saving S is equal to the aggregate investment. In other words, a closed economy can save only by building its capital stock. On the other hand, national saving for an open economy is equal to aggregate investment plus its current account balance. Now, how do we get to this? Well, using the national income accounting identity and the definition of current account, we know that for an open economy, aggregate income Y is equal to C plus I plus G plus the current account balance. We can simply rewrite this equation as aggregate investment plus the current account balance is equal to Y minus C minus G, which is equal to national saving by definition. Therefore, an open economy can save by building up its capital stock, that is by increasing I. Alternatively, an open economy can also save by acquiring foreign wealth, which is to say that the economy can have a current account surplus. Now let us understand the relationship between national saving and the current account through an example. Assume that Australia builds a hydroelectric plant. In other words, Australia's aggregate investment I increases. But it is not necessary for Australia to increase its aggregate investment by increasing its national saving. Australia can increase its aggregate investment by importing the necessary materials to build the hydroelectric plant from China and by borrowing funds to finance these purchases from China as well. In this case, Australia is increasing its aggregate investment by decreasing its current account balance or by incurring a current account deficit. If Australia's current account was perfectly balanced before making this investment. As a consequence, Australia's national saving need not change as national saving is equal to aggregate investment, which is increasing, plus the current account balance, which is decreasing. This example also highlights that a current account surplus can be considered as net foreign investment. To understand this, remember that in the example above, China is using its savings to finance Australia's current account deficit. When China lends to Australia, part of the income that is generated by the hydroelectric plant in the future must be used to pay the principal amount plus any interest back to China. This implies that apart from domestic investment, this kind of foreign investment by China is another way in which China can use its current savings to increase its future income. Now that we have understood what national saving is and how it relates to current account for an open economy, let us study the two key subcomponents of national saving: private savings and government savings. We denote private saving as S superscript P, which is equal to national income Y minus total government taxes denoted by capital T minus aggregate consumption expenditure C. This is intuitive. Just as for an individual, the total saving of the private sector is the total income net of taxes paid to the government minus the money spent on consumption of goods and services. Next, we define government saving. Government saving, which is denoted by S superscript G, is simply equal to the total revenue that the government earns through various kinds of taxes such as income tax, corporate tax, customs and duties, minus the total government expenditure G. Remember, if the total tax revenue in a year is greater than total government expenditure, then the government has a budget surplus. On the flip side, if the total government expenditure G is greater than the total revenue from taxes, then the government is said to have incurred a budget deficit. Once we have defined private saving and government saving, it is easy to rewrite aggregate national saving S, which is equal to Y minus C minus G, to be the sum of private and government saving. And since we know that national saving for an open economy is equal to aggregate investment plus the current account balance, this implies that private saving plus government saving is also equal to aggregate investment plus the current account balance. Finally, in the last equation, we are just rearranging the equation above to get the expression for private saving, which is equal to aggregate investment I plus the current account balance plus G minus T. When G minus T is positive, the government has a budget deficit. So what does the last equation mean? The last equation states that a country's private saving can take three forms: investment in domestic capital I, or purchases of wealth from foreigners, which is captured by the current account balance, or purchase of domestic government's newly issued debt, G minus T. Remember, if the government incurs a budget deficit, then the government has to borrow to be able to spend more than its income. And it is for this reason that the government issues debt. So this gets us to the end of this lecture, where we have understood the meaning of current account and national saving and how they are related to each other. In the next video, we will understand what we mean by the balance of payments of a country. Thank you.